Hello and welcome to today's discussion, ESG funds that outperform, getting the most out of data. My name is Elena Filipova, Global Head of ESG at Refinitiv, and I'm honored to have the opportunity to discuss today's topic with John Sturt, President and CEO of Calvert, and Robert Jenkins, Global Head of Research at Leaper at Refinitiv. Before we begin, I would like to cover a few housekeeping items. There is no dial-in number for audio, so please use the device and plug in your headphones to listen to the webinar. Click the media player on your screen to enable sound and video, and ensure that Flash is enabled on your browser. If the slides get stuck, please refresh your browser at the bottom of your audience console screen. You can expand your slide window by clicking on the Maximize icon on the top right of the window, or by dragging the bottom corner of the slide area to expand it. You can also expand the live screen window box. Please submit your questions to the speakers in the Q&A box. We'll ensure to get to those at the end of the webinar. And finally, the link to the recorded webinar will be emailed to you after the conclusion of the event. Please allow me to briefly set the scene. Environmental, social, and governance data and considerations are increasingly being integrated into investment and financing decisions globally. Whether framing an M&A strategy or reviewing partnerships across the supply chain, onboarding customers, adjusting portfolio weights, or approving loans, all types of organizations are using ESG data more intensively to gain deeper insights before making key business decisions. There are many drivers behind the accelerated momentum and the adoption of ESG considerations into the investment process, some of which we'll discuss today. However, data is still being quoted as one of the main challenges that the market and financial professionals are facing when assessing and managing ESG-related risks and opportunities. And yes, we've all got a long way to go in terms of better standards, definitions, as well as availability of actionable ESG data. Refinitiv plays a very active and important role in the process by enabling sustainable investment strategies for more than 2 decades, and we offer one of the most comprehensive ESG databases in the industry. We also collaborate with regulators, with multinational organizations, standard-setting bodies, and the investment community globally to introduce solutions to the market and enable efficient and effective integration of ESG into mainstream investment decisions. And the shift, which is so urgently required of capital towards financing a more resilient and low-carbon economy. Today, we plan to first have a conversation with John about the ESG landscape in the US, the state of ESG data, and then zoom into practical examples of leveraging important insights from ESG data across different investment strategies. Second, we'll then discuss with Robert the recently launched Refinitiv Leaper Fund Esg Scores, how investors can select the right ESG funds, and we'll wrap up with an outlook into the future. And finally, we'll allocate enough time at the end of the event to answer as many of your questions as possible, so please submit those throughout the webinar. We'll also be asking following questions. And here is the first one. Do you currently use ESG in your investment processes? Yes, doing it for a long time. Yes, but I'm a new adopter. Or no, not part of my process right now. So we'll kindly ask you to please choose your answer and submit. And let's take a look at the results. So that looks great. It looks like more than half of you are recent adopters, and we hope we're going to be able to provide you with some very relevant information, best practice advice, and additional insights so that you can accelerate your adoption. And about a quarter are long-time adopters, which is excellent, and a little over 20% are not yet including ESG consideration. But we hope by the end of today's webinar, you're going to change that and seriously consider how to approach and embark on this journey. Thank you. So, John, let's kick off the conversation and start off with setting the scene. Let's get a little bit more into the actual environment in the US. According to a Deloitte Insight report, ESG mandated assets could make up half of all managed assets in the US by 2025. That's 5 years from now. Can investors expect stock market swings, pandemics, and other similar challenging conditions to accelerate or decelerate this growth? What do you think?
Well, I'm not sure that this approach will have a bearing on those outcomes, but I think that the trend towards towards using ESG information in investment processes is well established, and that trend is going to continue, really, no matter what happens from a political perspective. Really, no matter what the actual outcome of the pandemic is, none of that is going to slow down the adaptation of the use of ESG information. It might accelerate it. I think it could very easily accelerate adaptation, but the underpinning was established way before these current events came about.
I see, and actually that's the global sentiment we're also hearing and experiencing across all regions and markets. Commitments are becoming bolder. There is a lot more momentum from the market, from regulators, and that trend is only expected to continue. If I reflect back on Europe, one of the key drivers of this acceleration is the involvement and the bold commitment of European regulators. And that's one example, but that's true also across other markets and regions. From your perspective, what are the key drivers behind that accelerated momentum for ESG integration in investment decisions in the US?
Well, you said it really well in terms of the regulator being a driver in Europe. The U.S. is really currently a market-based solution, and even though the regulator in the U.S. has not really been supportive, I think the U.S. is getting innovation and adoption, and I think it's just starting to really take form. Is a long pathway ahead of it, but I do think it's going to happen the way a lot of things happen in the U.S., based on what the market is going to give us and what the market is going to tell us. Yeah, I don't think it's going to be a regulatory change in the U.S. is going to drive how investors allocate this capital.
Okay, and I guess to also reflect on the recent development that happened in the U.S. Last month with the publication of the climate report by the expert subcommittee the Financial Market Regulatory Agency, urging the Fed, the SEC, and other financial market regulators to act with urgency on climate change and respond to it and deal with it as a systematic financial risk. What is your reflection on that recommendation, on the report itself, and its potential to influence the speed with which the market is looking into integrating ESG consideration into investment decisions?
Would you like me to continue?
Yes, John, if you don't mind reflecting on that report which came out last month.
Thank you. Well, I think these are really reasonable requests for disclosure and transparency that investors should be asking for. Many investors are asking for, and some companies are beginning to provide some disclosure around. So clearly the market is beginning to signal and move. It would be, I think it would likely be beneficial for the regulator to provide greater guidance and firmer structure. It's fairly early, and so one of the concerns that I have is that the company, the reporting entity, be really able to provide the information, and that there's some agreement that the information is the appropriate set of data to provide. I think that's been pretty well established. I think we're done with that part of the process. And so I would look forward to seeing this move into implementation.
Thank you, John. Let's ask the second poll question to the audience. What are the biggest ESG data challenges from your perspective? Is it lack of standardization and transparency? Is it limited coverage of ESG data and analytics across companies and other asset classes? Is it the high risk of greenwashing that's hurting trust in the data? Or is it hard to understand terminology and usage of different terminology? Or is it abundance of frameworks and scoring methodology which cause confusion? Or is it something else? Okay, let's take a look at the results. So the audience, broadly speaking, agrees that the primary challenge around ESG data is the lack of standardization and transparency in ESG reporting. So it does seem like the nature is to be mobilizing a lot of effort to bring that degree of harmonization and clarity around what data should be reported and mandate the reporting of the relevant groups, whether that's an insurer or another asset class. But there is also enough distribution across the other reasons. So it is not the only problem around integration and usage of ESG data in investment decisions. Okay, that's excellent. Thank you very much to everyone for contributing to this poll question. And I think that's a perfect transition to John. Maybe let's a little bit talk about ESG data. From your perspective, what is the state of ESG data right now? And feel free to reflect to the responses from the audience. In which areas is disclosure improving, and where it might be in the near future?
Well, I'm just coming right off of this question. regarding standardization being the area that people wish for the most. There is a growing list of companies, a growing group of companies, if you will, that are beginning to disclose under SASB and or TCFD. And this is happening in the US, this is also happening globally. And I think it's going to be 140 or so new companies disclosing this year. So it's pretty good momentum, and that's a big change in terms of what's happening with ESG data. I think it sort of changes not just having standardized data, it also in many cases changes how the data is viewed internally at the issuer, at the reporter, before it comes out and is provided to investors. So I think it upgrades the data quality, I believe, and it probably upgrades the visibility internally back at the reporter. And so that's where we are. We have a leading edge of companies that are really beginning to report, and it's having an impact on what they do internally. I think there's also a group of companies that has done an excellent job for a long time monitoring their internal operations, whether it's human capital or physical capital. They have their own set of metrics. In some cases they report, in some cases they don't exactly report. But the other aspect to understanding what is the state of the data is, do we really have the information to understand how companies are doing broadly? So on one hand, we've got more disclosure happening, more standardization happening. On the other hand, there's what is happening across all these companies that we're trying to analyze. And there, I think, in general, companies are in some different ways beginning to make progress on addressing critical environmental issues or people issues. But we don't really have the in-depth visibility across every small company to know in depth what's happening. But as we get more and more information, we do see that there is progress being made in many cases. So the overall trend appears to be fairly good.
I think you're making a great point that disclosure should not be done for the sake of disclosure, because that doesn't add much value both to the investor or to the issuer of data. It really is meant to be an end result of actions that companies are taking to better manage, better understood and manage those risks, as well as leverage the opportunities that the environmental and social challenges present to their industries, to their economies. So I think that that's a key message that we can certainly take away from your comments. And what level of data granularity would actually be necessary to conduct an effective ESG profiling? It's important to strike the right balance and not overdo it. How much of data granularity is required?
Well, let me discuss where I think the data can be used currently, and how we might think about granularity going forward. Right now, I think that the data is good enough to lead our analysts into an area of focus, lead them into a company where they want to take a more deep dive, or take a deeper dive, spend more time with that company's management or IR team, and get into an exchange of information, and possibly lead into some kind of engagement with the company. So I think the ESG data that we have available today broadly is adequate to lead our analysts into areas where they may want to focus. It's not 100% productive, but I'm not sure that there is a set of data that would be 100%, because at some point you have to get into the detail and start asking questions, with some context, hear what the company has to say, in order to really understand what you're looking at. So I think for large companies, the data is not bad and can get you to that level. And small companies, a little bit less so, but small companies, all these companies are so differentiated on ESG info. I do think we're at the point where kind of continuous improvement of this kind of data is great. It's going to happen. It's definitely going to happen, and it's necessary. And then we'll still need to take deep dives into companies. We'll still need to go in depth.
Great. One of the challenges is also highlighted in the poll question is the concern around greenwashing, and that companies might be leaning towards emphasizing and disclosing on the areas where they have good performance and avoiding a lot of information in the areas with not so good reporting. So what is your advice, John, for our audience, for investors, on how to deal with greenwashing and how to deal with data gaps?
Yeah, it's interesting, because the question was, what do you think are the biggest problems? It's possible that everybody says that greenwashing is a problem, right? So I think that's something that people could be concerned about. So is the company really giving me the facts? Well, if it's coming through the regulatory filing, it better be, right? It better be, and so certainly as investors, we're going to place greater emphasis on information that comes through the regulatory filing than anything else. And that's important. So getting this built into the process, I think, would strengthen the usefulness of the data and of the information. But I also think that, very respectful of the fact that we're going to just continue to build the system that we need to build to strengthen in these areas. That's where we are right now. That's where the focus should be. At the same time, we're building a system to understand the actual impact that companies are having, to understand the impact that companies are having on the environment and on people, both their operations and their products. So there's going to be continuous development of information that can be used by investors and by policymakers to build a stronger economic system and strengthen the capital allocation process in the capital market system. That's what this is all about. And ultimately, the next set of data that I think will be stronger will be really looking at the impact and being able to convert that into economic terms that can sit alongside of dollars and cents on the financial statements.
Mm-hmm. Yeah. It's an evolution journey, and that's true also for the data. Maybe let's shift gears and talk a little bit about actual implementation in practice, and you as a pioneer and a practitioner, your insights would be quite valuable for the audience. So as it is an industry that's evolving, it's a journey. There is a lot of innovation and diversity in investment strategies that integrate ESG considerations. Let's talk a little bit about them and how to enhance investment decisions, how to deliver better performance by leveraging important signals and insights from ESG data analytics. Can we maybe start with risk mitigation?
Sure. I think this is always the case. It's important for the investor, the asset owner, to have a clear picture of the risks that they want to measure. The risk could be exposure to fossil fuels, could be exposure to carbon emissions, could be exposure to water stress. What are the specific risks that should be measured? It's best to do that, we think, at the industry level, because obviously what matters to a software company is very different than what matters to a utility company. So asking that question, what are the relevant risks at an industry level, and then putting a weighting on that risk is a very logical approach. Getting the data in order to assess how a company is exposed to that risk and managing that risk is critical. That's where the ESG key performance indicators or the ESG data comes in. And obviously bringing that data into the model at that point, once the analyst has built the model, said, hey, here are my major areas of exposure. Here are my big factor sets that I want to analyze. Carbon intensity, overall carbon emissions, exposure to water scarcity, human rights, respect for human rights, indigenous people's rights, the whole human capital, community engagement. There's going to be a whole set of 8 or so themes that'll roll up and be weighted. So the question is, what's my weighting and where do I get the key performance indicators so that I can measure each company in each of these critical areas? That's where the ESG data comes in.
And what has worked well for Calvert funds in terms of risk mitigation strategies?
Well, the data that we have seen for long term indicates that companies that are clearly at the lower end of the performance spectrum on financially material ESG performance factors have the potential to underperform. We have found in our indexes. Seek to eliminate the companies really at the low end of the spectrum and invest in everything else. Companies that just meet our principles, just need to be acceptable. So it's the minimum bar, if you will. That actually has been a very good strategy for us. It's allowed us to provide index coverage generally to our clients with benchmark-like performance. So it's done what we wanted to do, which is reduce ESG risk, but give back the market essentially to our clients. And so that's actually been a popular strategy. We also have active managers who have then sought to add value to those universes of companies through their active security selection. And some of those have done very, very well. Really across the board, we've had periods of outperformance. In some cases, those periods have been for longer time frames. And small cap, mid cap, international. International has really been very strong, as is U.S. small cap and mid cap. So lots of areas to point to on the active management, where the active managers have been able to add value also over and above what the indexes have done.
Excellent. And how about some of the other responsible or sustainable investment strategies, like best-in-class selection? Or maybe can you comment if you believe engagement delivers long-term value creation?
Yeah, there's certainly evidence to show that some types of best-in-class approaches have merit and can add value. So the question is really, where is the line between just looking for a company that's extremely well run and looking for a company that does well across all of the material ESG performance areas? Because there's certainly a lot of crossover between what it takes to be an excellent company and what it takes to do well across all the material ESG performance areas. So in a very real sense, when you say I'm going to look for best in class, you're saying I'm going to look for the companies that in many respects are the best run companies. They're doing the best job for their people. They're doing the best job for the environment. Consistent with that, they have the best products in their area, or they have the best retail strategy, whatever it happens to be. So there's a lot of merit in the best-in-class strategy. For some ESG investors, it's exactly what they want. However, for some investors, particularly sustainable investors, they might say, well, I also want to have an absolute bar. So I still want to stay away from fossil fuel companies or companies whose very business, had a big impact on the environment and might be, a big contributor to fossil fuel emissions. I want to just stay away from those. So as opposed to saying I'm going to buy the best in that class, I'd like something that also has a filter on it or a way of assessing that kind of risk, so that I'm steering clear of that type of very, very high risk from my portfolio overall. So best in class might not get the client exactly what they're thinking of, exactly what they're looking for, but it certainly aspects of it, I think, are important concepts and can be really useful in implementation. And for some clients, it's just perfect across the board. Yeah.
And in what cases would you suggest and say engagement is complementary and should be part of the process?
I think engagement should be part of the process across the board, because we have a lot of information and we're developing new information and better ways of using the information every day. And we have information that can lead us to be able to say, here's something that we can see about this company. It's different than the other companies. It's lagging or it's leading. And we'd like to have a couple of companies do things differently, because we think it would be an improvement. And it would drive shareholder returns, and it would be good for their employees, or it would be good for the environment. And so I'm using the data as I think it should be to improve the system overall, with a focus on the stakeholders in the environmental or people categories, as opposed to just financial. So I think engagement is extremely important. I think this information, this data has a lot to offer. And I think companies are very interested. Companies are, if you bring the data in a useful way, if you can, hey, here's how you look, here's how your competitors look, here's why we're talking to you, and here's what we think this can mean for the company if you solve for this issue. Here's why we think this is a good idea. I think that kind of engagement, where the CFO will say, okay, I get it, I see how this is going to translate into improved brand value, it makes total sense, you're going to get one response. If you come in and the people are saying, I can't believe they're asking me to do that, it doesn't relate to my job, it doesn't seem to make sense for the company, it's going to be a long haul, it's going to be difficult. So if you've got a company that's really way out of it like that, okay, let's take it on. Let's start there. Let's get on it. But today, I think it's much more about helping companies strengthen things that they are already directionally headed towards.
Great. Very good suggestions and pointers there. Thank you, John. I see that there are some excellent questions coming through from the audience. Thank you so much to everyone who is submitting questions. And just to remind everyone else that might be having questions on their mind but have not yet submitted them, to do so by using the Q&A box. So let's maybe talk a little bit about some solutions that are available in the market. And Robert, back in July, Refinitiv had a press release announcing the launch of the Lipper Fund ESG Scores, which are designed to serve as pivotal data metric in the transition to sustainable investing. Can you please share with the audience some additional information about those, as well as the breadth and the global market capitalization coverage of these scores, and the types of themes that are being covered, and enable to measure across those areas for fund managers, advisors, and investors?
Sure, Elena. Yes, as you mentioned, we have just recently rolled out the Lipper Fund ESG scores over the course of the summer, and we're still building on the coverage that we have right now. We just recently crossed over about 30,000 funds, covering about 100,000 share classes, and they're primarily globally. So the idea is to really capture all styles and cap ranges and all global regions at the end of the day. But certainly, they're equity focused at first, and they need to hit certain coverage hurdles, if you will, in order for us to include them in a score. So currently we do have a little bit more, if you will, coverage in the larger cap developed market regions than we would say in smaller cap emerging market regions, but we have really quite a bit of coverage, as I said already, and it's only going to increase over time. Now, again, the primary hurdles, if you will, or requirements that we look for in order to score a fund is, number one, we want to make sure that we have good coverage of the underlying assets. So if we have at least 70% of coverage across the total in assets in that fund, then we will score that fund. And for the companies for which we don't have a score, we will rebase, if you will, them out. So we're really focusing primarily on the companies for which we do, in fact, have coverage. And we also look to avoid having overly concentrated portfolios. So portfolios only got 5 holdings, and we have scores on 4 and what have you. That's not going to be enough. We want to see at least 10 holdings. So we're looking for at least a little bit of diversity, if you will, in the holdings section. So these scores have come out, and we're going to continue to work on them and develop eventually a ratings-based approach. The Lipper Fund scores are based on the company scores, which are very transparent, if you will, straight pass-through for the most part of company disclosed data right into the score. So as we continue to develop that, will eventually come out with fund ratings, like kind of like a one type of rating against the fund, so that investors can get a sense of, within a given particular peer group, what are the funds that have the best kind of ESG disclosure footprint.
Mm-hmm. And as you mentioned, the fund level scores are based on the Refinitiv ESG company scoring. And earlier this year, Refinitiv made a number of enhancements to the scoring to make it more data-driven in addressing three major industry challenges, namely around materiality, transparency, and size biases. Can you maybe walk us through that approach and value in providing more objective industry peer comparison for investors and companies? And that actually connects to some of the questions coming in the Q&A window around differentiation between Refinitiv approach and what's available in the market.
Sure. So essentially, the Refinitiv company ESG scores, which have been around for many years, but have recently, as you mentioned, undergone some renovations per se. In general, we have and capture about 500 key metrics from company disclosures, and of those, we essentially cull out about 180. And those 180 metrics will inform across 10 key underlying ESG themes, approximately equally spaced across the three ESG pillars. Those themes include things like emissions, environmental innovations, human right, diversity, inclusion. Those are the types of themes that populate, again, the three ESG pillars. And at the fund scoring level and at the company scoring level, we actually have scores across the 10 themes. Now, in general, what Refinitiv does, and what it does a lot differently than others, is it's a straight pass-through of company disclosed data, which has enabled kind of a complete degree of transparency and auditability back to the source of the data. And the score itself is in no way, shape, or form impacted by any subjective measures or filters along the way. So when you think about what's going on, and I won't name names of competitors, there is a lot of qualitative components to the scoring that is done by competitors in the ESG fund space. This, again, is very much, again, a straight pass-through of objective data. There is a materiality, what we call magnitude materiality methodology that is employed along the way, such that companies within given industries will have more, if you will, weighting to aspects of the key performance factors that drive and inform thematic scoring underneath the ESG pillars. So there is kind of that materiality component is incorporated within. But again, I think unique and different in terms of the competitive landscape, there is complete transparency. And another thing that we do at the company scoring level is a stimulation, if you will, of transparency, which is essentially penalizing, if you will, companies who aren't delivering the same level of disclosure that their peers do in that industry or that space. And by that, we are essentially going to reward companies who are disclosing better than companies who aren't. And so you'll see that manifest itself. In some cases, of course, smaller mid-cap companies will be a little bit biased in that regard, but we simply solve for that by lumping them against their peers at a cap range. And so therefore, they may not have the same level of disclosure as a larger cap company, but when we look at them in terms of their scoring, we'll be looking at them in a peer group that will essentially adjust for the level of scoring done at that cap range, if that makes sense.
Thank you, Bob, for those clarifications. I think it's time to go to the third poll question for the webinar today. And that asks our audience to reply on the question of, do you believe that ESG funds outperform their peers and are more resilient? Yes, no, I don't know. Let's take a look at the results. There is a 100% consensus, at least within our group, of yes, it's highly likely that ESG funds outperform their peers. Maybe, Bob, I'll let you as well comment on this question and reflect on the answers from our audience, as well as provide your guidance to investors and advisors on how to go about finding the right ESG funds for themselves and for their needs.
Sure, and it's warms my heart to see our audience on that particular question coming in as they did. As many know in this space, ESG funds have been long suffering the myth that they generally require you to take a discount to your performance when you invest in them. And in fact, for years, some of the ESG products out there were done and created in a fashion and run in such a fashion whereby they were using a primarily negative or exclusionary screening approach, which is where you simply eliminate entire industries and such. And inherently what that will do oftentimes, it will limit the universe of stocks that a portfolio manager can invest in. And whenever you limit essentially the diversity of a portfolio, you start to increase risk and you limit the upside opportunities. And there are also, by the way, a lot of these stocks that get typically eliminated in these exclusionary approaches tend to be really well-performing stocks with strong cash flows, good valuation, strong dividends. Oftentimes, value-oriented securities are doing just that. They're low value because they're in sensitive spaces and they're providing high dividends. So and there was a period of time where people were missing that. So when you think about as an investor, how do I come into this space and choose the fund that's right for me? And I will tell you that there is a lot of choice out there. This industry is evolving at a rapid clip. Products are proliferating at a rapid clip. And there's a variety of different kind of themes underneath, and then John touched upon some of them. But just to be high level about it, I'll give you kind of the two extremes of the spectrum. You have, again, that negative exclusionary approach, and you have kind of a more positive and inclusionary approach. And there exist flavors in between those two pillars, if you will. But in those two pillars, they're very different approaches. One, of course, as I mentioned, you're simply removing industries completely. And you'll see a lot of ESG funds nowadays will have absolutely no presence in the energy space. So you won't find oil and gas producers in their funds at all. And they'll be very judgmental, if you will, in any carbon-intensive company. And so you'll see only a smattering of carbon-intensive companies in general in a lot of ESG funds. And that really bodes well for investors. Whereas, if you will, kind of a positive or inclusionary approach fund is looking to have a broader palette of choices that they can invest in, but they're looking for companies who are true leaders. And it's one of the things that John talked about earlier as well. Oftentimes, companies that are true leaders and innovators and are doing so, if you will, incorporating ESG properly into their businesses, they tend to be well-run companies. In a kind of a classic Warren Buffett type of way, these are companies that are probably going to do well because they're managed well. And that is why, to this poll question, we do see a lot of strong ESG footprint type companies actually performing and delivering on total shareholder value quite well. So when you come in, again, there's a variety of choices. You have kind of blanket ESG funds, or general ESG funds, if you will. And you have a lot of thematic, like a fossil-free fund or a diversity and inclusion fund. I would say as an investor, you need to kind of think through and self-assess what is most important to me in terms of ESG themes. And this is important because, again, you're going to find that there's a variety of flavors. You really want to kind of match the funds that you're going to invest in with exactly what your value system is. ESG, if anything, is extraordinarily personal. And this is what we're finding as an investment management industry going forward, certainly is going to have to cater to that over time. A lot of the initial products that were rolled out in the ESG space were just ESG funds or socially responsible funds. And they were trying to do everything under one wrapper. And I think that as we continue to move through, and as if you're an investor looking for a specific fund, you may not get exactly what you want in one of those umbrella funds. And there are a lot of thematic funds out there that you can go for. So kind of self-assess what you want in terms of your values being exposed within your portfolio. And then think about, again, do I want to completely exclude industries or do I want to encourage leaders in industries? That's a very important thing. And from there, you can really start to narrow essentially the selection pool that you're looking at for funds in terms of the ones that are going to absolutely hit upon what you want to hit upon. Now, when you think about the funds and you start to say, okay, I want to be an exclusionary type of fund. I don't want any fossil fuels in my fund. Or I want to actually find, again, those innovators. Now you got to think about what type of management style is best for that. Now, arguably, if it's a straight up exclusionary style, you can find actually passive products or if you will, very low fee active products to do that, because it's not necessarily a difficult thing to do to simply eliminate an industry. However, if you're looking to have, again, a more positive focused fund, it's best to find an active manager who actually knows what they're doing in the space. And I'll shamelessly applaud John and his team at Calvert as being one of those managers who have been at this for a very long time. They have a deep pool of talent in the space and expertise at picking ESG companies. And you really need that, because we've already gone over for about 20 minutes today how difficult the data is. And so you essentially need an asset manager to sift their way, an active asset manager, to sift their way through all that data. So I'd recommend, if you want to go for kind of the inclusionary positive type product lines, best finding an active manager, one with experience. You may not always find one who's actually run an ESG fund, but at the very least, for instance, if you want to just say go to a fossil fuel free fund, see if you can find a portfolio manager maybe with an energy analyst or an energy sector PM. They certainly know that space, and they probably have good expertise to bring to the table. So those are some of the things you do right now in terms of how to pick a fund.
Mm-hmm. Also great points there, and maybe just, Robert, if you can provide any additional comments. If we look ahead, what do you see are the future trends in the ESG fund space?
Well, one thing, and we're already doing this, and a lot of our competitors in the fund rating space are doing this, we're rating all funds. And essentially, I would say 5 years from now, it's going to be a necessary step in pretty much any fund selection process. Certainly if it's a fund selection process into an advisor platform or into an institutional platform like a retirement account, we're going to be looking at ESG for every fund. So having, for instance, an ESG themed fund is going to be less important. Now, there will still be ESG themed funds, I think, out there, absolutely. But I think what you're going to find is probably a little bit more focus on themed funds, not just the broad ESG umbrella or social responsible umbrella, but a carbon-free fund, or a climate impact fund, or a diversity inclusion fund, or a fair practices fund. And that way investors can kind of pick and choose amongst the funds that absolutely exhibit kind of the values that they want exhibited in their portfolio, and then they can weight them accordingly. So I think we're going to see definitely a kind of a proliferation, if you will, of more thematically focused funds, and maybe less focus on ESG funds, since quite frankly, every fund's going to be looked at from an ESG lens going forward. So I think that's going to be kind of the future of the industry in that regard. Certainly it's going to continue to grow in importance. And I think it's going to be, again, a standard part of how an advisor talks about the investment solution that they create for their end investors.
Great. Thank you so much, Robert, for sharing those insights and providing the clarifications. Let's move on to tackling some of the questions submitted by the audience. And we already did cover a number of those, but John, maybe I would like to turn to you with a quite relevant question that we hear as well from other customers, and it's coming through the audience. And it says, do you think that it's right to include the ES and the G components as part of one rating, as they are so different? From an investment point of view, what is the degree of granularity, or at what stage of the hierarchy do you think, or do you suggest to investors to focus on and start their assessment?
That is a great question, and very well informed. And I will just tell you what we've designed, what our discipline is. We start at a granular level, at the company level, and kind of work up from there, if you will. The companies are dealt with in fairly narrow peer groups. We have 200 custom peer groups, or approximately 200 custom peer groups. You can think about it like GICS, sub-industry sectors kind of level. But then once you're into that peer group, the analyst has built a model that looks at the specific performance areas that the analyst thinks are most financially material to that group of companies. So they built that model based on financial materiality. It could be heavily weighted towards environmental issues, could be heavily weighted towards human capital management. So whatever the analyst clearly believes is most appropriate from our framework's perspective for that particular peer group. So that really then uses the key performance indicators that we have, which are proprietary. It uses them at a pretty granular level. Yeah.
Makes sense. And from our experience, we do see investors approaching it at different level of granularity, whether it's looking at it thematically because of a specific investment strategy, or really starting at the top as a filter to identify laggards and leaders. There is no one size fits all. There's a lot of flexibility and a lot of innovation.
Really good point. So if you wanted to create a portfolio for a client who really wanted to avoid anything with significant carbon emissions, not just fossil fuel, but you wanted to get rid of steel and concrete, a lot of heavy industry, for whatever reason, you could certainly use this data at that level to do that. You could use the ESG performance data to get rid of companies with heavy emissions across industries, if that's what you wanted to do. You could use it to tilt towards companies with more diverse boards or better diversity programs. There are things you could do that would try to accomplish a specific objective. Yeah.
Agree. And another great question that has come in and might be relevant to other attendees today is, I'm new to this. How are companies self-reported data audited to ensure they're accurate? Robert, do you want to pick this one, or John?
You kind of cut off a little bit. Your voice cut off. The auto. Could you repeat the question?
I think the question is, how do we know the company reported data is accurate?
That's a very good question, and there is a degree of self-serving that goes on with how companies go about disclosing their data, as anyone who's ever looked at the data can tell you. And oftentimes, I know what a lot of thoughtful asset managers do, John, I'm sure your team does as well, is you kind of basically triangulate your data sets, and you come in at it from a variety of different perspectives. And not everything is kind of the easy to get data directly out of a company report. Sometimes you have to look at outside sources that are doing surveys or what have you, or they're doing kind of their own data collection against the key metrics you're looking for. And you need sometimes to have like a collection of different data sets to come in to make sure that you're truly capturing kind of the entirety of a corporate picture. And so in general, it's really accessing as much as you can data from a variety of different sources and different perspectives, whether it be, listening into their corporate earnings calls, hearing what is being said in the press, looking at via machine learning to try to pull out kind of themes that you're seeing, and certainly any sort of kind of creative way of, for instance, really truly getting at emissions, for instance, of companies. You need to do all those things in order to really get an accurate picture in some instances.
Diversity of sources is critical, and another indicator of the accuracy of the data is that many companies are actually getting auditing firms to review the ESG data that they submit in their corporate sustainability reporting. And I think that can be quite a good indicator of the robustness and completeness of the data by validating the auditor statement, similar to financial information and the auditor report. The time is not in our favor cover today. So let me maybe ask both of you for a quick comment on a final question, which says, is implementation of ESG strategy helping to mitigate risk and volatility during the broader market sell-off earlier this year? As we're still in a challenging market environment, I think it's important to provide your insights on that question. John, shall we start with you?
It has had a modest impact in reducing volatility during this time period, but I think that is partly because many of the companies that are very sensitive to the economic cycle are sources of volatility during this particular period. And those are areas of underweight for lots of ESG-oriented portfolios. However, there is some evidence that suggests that companies that had good ESG scores, ESG programs in place coming into the pandemic, it seemed to have responded pretty well in terms of what the media thinks and what their employees think. So there's some early evidence that suggests that the companies have at least gotten off on the right foot.
Yeah, I would echo that, and I was going to say simply essentially the same thing. Kind of the ESG footprint of a company and a portfolio of companies is very likely dependent upon the impacts of the exogenous events that have just taken place. And what we just saw, for instance, with the COVID crisis was almost complete stoppage of people jumping in their cars or getting on trains or flying. And thus, to John's point, if you happen to be excluding that carbon-intensive sector, you did pretty well. But I think broadly, well-managed ESG companies, to the point we made earlier, tend to be in a better risk position regardless of the event that takes place. There could be instances, again, where the circumstances of the event may actually put ESG companies in a strangely poor place. But I find that hard to believe and hard to envision. I think in general, good, well-managed companies tend to be the better place you want to be in any macroeconomic environment.
Thank you. Managing ESG risks is really managing financial risks. I guess I would summarize and wrap up that conversation. Robert, John, thank you so much for sharing your expertise and insights with the audience today. Thank you to our audience for the great questions. We didn't get to all of them, but anything that we didn't cover today, we'll get back to you via email with feedback from our presenters. As well as we invite you to request a 30-day complimentary access to the Refinitiv ESG data and use it for free. And you can do that by clicking on the window box next to your Q&A section. Thank you again, and wish everyone a great rest of the day.
Thank you.